The repo rate has recently hit a 14-year high, and with subsequent interest rate hikes, homeowners across South Africa are facing unprecedented challenges when it comes to affordability. Those who are considering to buy their first property are now thinking twice about what to do. So what options do property owners and first-time home buyers have in this environment, and how have the rising interest rates changed the property trends? For that, we are joined by Andrea Tucker, the director at online bond originator MortgageMe, on how to manage higher interest rates and the resulting impact on home loan repayments. Andrea, thank you very much for your time this afternoon. I wanted to start here in terms of the property trends that we've seen since the interest rate hiking cycle started more than, at least I'll say, 18 months ago. How have they changed recently, as you have the data with you?
So I pulled some stats before I left work this afternoon, just to get a view on quite how desperate the numbers are looking. Times really are tough for South Africans, and the home buying market and banks, home loan granting banks, are absolutely feeling the pain of the fact that volumes are significantly down with every single interest rate hike, and we've had many of them in the last 18 months. Your average South African just becomes less likely to be able to afford to pay off long-term large debts like a home loan.
So let's talk about those who are in the first-time home buying market. Right now, they are thinking twice. But as the Reserve Bank governor has said repeatedly, it is time to take the pain now and probably later, suggesting that we could be seeing an easing of the interest rate hikes. Is it a good time to actually buy right now?
If I had a crystal ball, I would be able to tell you when the home loan rate cycle is going to turn and we should see a decline. But none of us know. There are some indicative stats out there which say that we're in another tough cycle for possibly another 12 to 18 months, where we hopefully see one more increase and no more than that. Rates stay as they are for the next 18 to 24 months, and then we start seeing that decline. What I can advise anyone who's looking at purchasing a home is that it is absolutely a buyer's market at the moment. I've just bought a property myself, so I can say with first-hand experience, 2/3 of the properties that I was looking at have already seen their prices reduced. And that just means that you're getting a really good value for money if you've done the calculations and run those numbers. And my advice to anyone who's about to take on long-term large debt like a home loan is to set your property buying bounds quite strictly. Once you've done that affordability analysis, you know how much of a bond you can afford to take up based on the installments that you would look at paying on today's current interest rate. Do that calculation again with 1 basis point increase, which I'm hoping we don't ever get to see, but it's certainly worth doing that calculation with whatever rate you've calculated today, plus another percent. See if you can afford a bond at that price. Then I'm going to recommend that you do that calculation yet one more time on another basis point increase. So that would take us to today's rate, which is the highest rate we've seen since 2014, if I'm correct, and run your calculation stats on 2% on top of that, which should prepare you for any shocks that we're hoping as an industry we don't get, but it's certainly worth calculating based on what your income is, what percentage of your income you would be looking at to pay off your long-term debt like a home loan. So do those calculations at least 3 times before you consider taking the plunge. But if the numbers stack up, you are absolutely certain to get a good deal, because people who are looking at selling at the moment are desperate to sell. They're people that can't afford to pay off their current bond installments, and they know that they need to downsize. We can talk about that a bit later. So they're looking at making a quick sale. There are also a lot of people that have semigrated down to coastal regions. There are people that have immigrated, and there are many properties at the moment sitting empty, and people are just looking to sell, and they are absolutely going to be willing to reduce their price in order to effect that sale. And that is where buyers and the term buyers market comes in that you can get really good value for money if you can afford the bond today, and possibly with 2 more interest rate shocks ahead of you.
Let's talk about homeowners. What are they actually doing, and what is the data showing us? Because there are people who are switching, there are people who are taking advances on their home loans, and some are actually downsizing. But in your view, you're saying that downsizing is not all prepped up to be.
No, it's not. So we track the home loan registration numbers on a monthly basis. We roll those up into quarters, and then we compare quarter and the most recent 3 months versus the 12 months before that. Every single bank is showing figures are down on average of about almost 17%, which just means that there are 17% less people purchasing homes in the last 3 months as the average for the 12 months before that. And that is what has caused the banks to relook at their credit funding and how they are actually making offers. And they really, really want to offer a good, viable credit customer a home loan. They're going to make a lot of money out of you over the 20 or 30-year period of your loan. So they're willing to reduce the rate that they offer you quite drastically at the moment, just because there are fewer buyers now than there were 12 months ago. What the stats also tell us, if we drill down into the types of bonds registered, is people are desperate. I've said it already, and we know this. We have all experienced going into the grocery stores and having to pay a lot more money for the same size basket of food to feed your family than you were a year ago. And what bond registration numbers are telling us, if again we compare the same period, the last quarter versus the 12 months before that, is there's a significantly larger portion of people who are registering switches, which is a bond where, it's in effect where you've gone to another bank to get a new bond, hopefully obviously at a lower interest rate. So a switch is measured differently to a first-time bond on a property, and those numbers are up. So people are shopping around and looking for a better interest rate and having to go to another bank to get that. But there's a short-term cost to register a new bond, and every person who looks at doing a switch needs to make sure that they've got that cash available, because that's payable in the first 3 months after you've applied for a new bond or a switch on that property, and you've got to have that cash available. And then you again need to run the numbers to make sure that you are paying less on a monthly basis, but that upfront switch cost doesn't make this something unaffordable and a very unsensible move to make. We can drill down even further and look at those stats which register whether someone's asked for an advance on their bond, and those numbers are up as well. And what we are suspecting is that there are a lot of people that are taking on additional long-term debt in their home loan because it does come at the lowest possible rate, but they are possibly using that money just to live, just to come out at the end of the month even, which is a very scary thought if people are doing that and making decisions to live in the short term while paying it off over the long term.
This has been an old debate, and I'm sure we're not going to solve it right now, but a variable interest rate versus a fixed interest rate, which one would you go for, since you recently bought a property? Because you do the one with a variable interest rate with the hope that things are going to get better. But which is the best one, particularly for first-time home buyers?
Look, I'm not financially accredited to give anyone advice, and I've had this debate at the office this week, actually. I elected to go with a variable interest rate because I live in hope daily that we will see some positive change in the country. We're going to see our economy do what it should be doing, and we will see the benefit of these interest rate hikes on inflation and on the overall economy and what those GDP figures are looking like. So I've gone with a variable rate. But if I had elected to go with a fixed rate, I probably would have fixed it for 18 to 24 months. I don't think banks are willing to fix for any less than 24 months at the moment. And I do think that we're going to be sitting at a similar level to what the rates are at now for the next 24 months. So if you are willing to fix, know that it is risky because we are expecting rates to come down, but we're not expecting them to come down in the short term. We're looking more at a medium term shift down towards lower rates.
Andrea, I wish we had more time. Thank you very much for your time this afternoon with us. Andrea Tucker is the director at Online Bond Originator. MortgageMe, talking to us there about the options that you have when you are a homeowner and are having some tough times keeping up with the affordability of your bond amid the high interest rates, saying that speaking to your bank is one option, but switching is really not advisable.